Is this just a routine shakeout in stocks after this powerful month-by-month rally, or a sign of a much tougher tape ahead? Here to discuss all that is Ritholtz Wealth Management CEO and CNBC contributor Josh Brown. So, Josh, we can write it any way we like. We could basically say everything lined up for this. We had a 5-month winning streak in stocks. Sentiment was getting a little bit frothy. Technicals were stretched. We have a negative seasonality. Something's going to come along to maybe create an air pocket. And we did that. On the other hand, we also had a lot of bears capitulating. The economy looks really strong, and everybody agrees with that. So do we have, the makings of a perfect, ironic top in the market? Where along that spectrum would you sit yourself?
Well, as someone who is really good at explaining what just happened, I would say that this is not very much more complicated than sell the news. You had a huge run up into this earnings season. We're in the middle of it. I think we're on track to see a 7% decline in earnings for the S&P 500, which was the expectation for this quarter. And that's where we are. And, you've had a lot of beating, believe it or not. If you look at that, we've had 51% of S&P companies report earnings, and you have 80% of these companies beating on earnings, which is the highest number we've seen in 7 quarters. So you're getting those good results. That was the reason for this huge rally we've had since May. Okay, we have them now. 64% of companies beat on revenue. Now you could say, well, that sounds low. Shouldn't it be like 72, 73? Yes, but here's the other way to look at that. You're seeing companies with decelerating revenue growth still finding a way to beat on margins with that earnings beat. So I think on balance, we're getting the justification for the rally we've already had. We're not really getting a justification for further gains from here. One thing I want to point out, very strange situation. Look at the reaction in stocks after they report. The companies missing numbers are doing better on average the next day than the companies beating. Let me put some meat on those bones, and then I'll turn it back to you. Companies reporting a beat on earnings, and a lot of my companies have beat and fallen that I'm involved with, an average price decrease of 0.7%. The 5-year average is +1. So it's not even an environment that's rewarding better than expected reports. So if we just accept that we've had a lot of the run-up and we're just getting the news that people are selling on, I think it's a better take than, something's materially changed, because we're still in an uptrend. You really have to pull the lens back, and you can see that.
There's no doubt. You look at the chart, the trend has been encouraging. We've kind of been rotating around. The market's broadened out. I was pointing out earlier that the lows for the day today, and really where we're trading right now in the S&P, is its 20-day average, right? If you want to be a real kind of scalper, short-term trader, that's what you look at in terms of buying the first dip. On the other hand, the sweet spot that the market has been in, where essentially we got comfortable that our companies are going to make their numbers. The economy seems like it's far away from recession, and yields weren't doing a whole lot. Maybe there's a little more complication here, and we were in a market mode that wasn't really interested in thinking too hard about the tough stuff. And we get this Fitch downgrade, we get yields going above 4%, and the sweet spot looks a little bit less sweet.
All right, so the Fitch thing, these are not serious people. I think it almost seems like their intention is to influence the negotiations in Congress, but nothing's really going to change there. We've basically gone 20 years letting the Fed worry about the budget, and both sides of the aisle are guilty of this, and none of that has been a reason to stop investing, and I don't think that's going to change anytime soon. It's true. Debt is going higher. Deficits are going higher. The spending has gotten out of control. The stimulus plans are actually creating more inflation. Fine, that's okay. I don't think it's the main thing here. What's most interesting in fixed income right now, at least to me, is the steepening. Every treasury yielding 3 years or less is down right now. Every treasury bond yielding 5 years or more is up. The 10-year, 2-year spread is now down to minus 0.82, which is the least inverted it's been since the failure of Silicon Valley Bank. To me, that's the big story. The 10-year yield is now back at its highest level. You have to go back to Thanksgiving. It's only 14 basis points away from the 2022 highs. That's the story here. It's a good story. It's a story of an economy not poised to fall into recession. Let's just take it as that and not try to make it more complicated.